Hello, chart watchers, and welcome to this Tuesday, March 27th, Market Watchers Live Show with your hosts, Tom Boley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Had a great day in the market yesterday, and we are continuing that move today. You can see the Dow Jones Industrial Average currently up over 200 points, the S&P 500 up 14, the NASDAQ following suit up 16, and the Russell 2000 lagging a bit today and is flat. 10-year Treasury yield moving lower. Money is rotating into the Treasury market today as the yield now approaches that 2.80% level where we have been holding for the past 5 to 6 weeks. Volatility continues to settle down. We are down about 3.75%, closer to the 20 level today. Financials among the leaders, rebounding very strongly as it did yesterday, up about 16 cents or a little bit more than 0.5%. Consumer staples also having a strong day after a strong day yesterday, up nearly 1% today. Gambling stocks back making some headway to the upside after 3 days of pretty big selling, as you can see. Gapped up yesterday, continuing that move back up through its moving averages today. This is a group that's up about 3% today, having a really strong day. 3 companies reporting earnings. Red Hat, after the close yesterday, came out, blew away top line and bottom line estimates, issued an upbeat guidance, the stock up $6 to an all-time high. It is showing a black candle. Maybe we'll talk about that a little bit. You can see on all 3 of these, we had gap ups with strong earnings. McCormick, also INFO. All 3 of these strong moves at the open, but so far followed by selling after the open. And with that, let me bring in my co-host, Aaron. How are you doing this morning? I'm not hearing you.
I'm doing just great. How are you doing?
I am doing just peachy. I'm getting closer and closer to a vacation. So I'm feeling much better as I get closer to that. I will not be around next week.
Yes, I'm on my own with Mr. Schnell, I think, for the majority of that time. So it should be quite fun as we get together and talk about you behind your back.
That's fine. I'll be riding rides at Disney. You can say whatever you want. I'm fine with it.
Okay.
You're in good hands. Greg's always fun to do the show with, so that I'm sure he'll be talking a lot of commodities and so forth, and I know that appeals to a lot of our listeners as well.
Absolutely, and of course all our Canadian ones as well. So
yes,
should be a good day, though. We've got a lot on the agenda today, but first I think we'll probably want to take a look at what's going on the rest of this week. And tomorrow we have Mark Young from the Wall Street Sentiment Survey. He is going to be here to talk sentiment. And then Arthur, who we actually talked to this morning a little bit, will be with us on Thursday to talk about the market. And then Friday is a vacation for us all. Hopefully all of you. Market is closed, so we will not be having our show on Friday. So short week, and you get to start your vacation early. So today we've got everything stock charts. Grayson Rose is here to talk to us. And after that, we're going to do a don't ignore this chart. We're going to look at some of our previous articles and see what's happened to some of those stocks that were talked about in those blogs. 10 and 10 to 1, our first stock will be Kohl's, KSS, if you want to go take a peek at that before we get to it. And finally, we will be finishing with what would you do? And the question is up already in the polls section of the chat area. So feel free to vote on that, what you think about XLF.
All right. And and the XLF, that'll be an interesting one today because, of course, we have been, we've been struggling with, the rate hikes and getting a lot of mixed signals from the 10-year Treasury yield. And that, of course, tends to offer some direction for financial stocks. So I'd be really curious to see what everyone has to say there. And but in the meantime, let's take a look at that 10-year Treasury yield. We had a couple of economic reports out this morning. January Case-Shiller HPI, Home Price Index, rose 0.8% versus the 0.7% that was expected. So that was a little bit of good news. But then we came up short at 10 a.m. Eastern. March consumer confidence came in at 127.7 versus expectations of 131.0. I was looking a little bit at the report, and it did mention the fact that a lot of folks are now expecting that or a lot more folks are expecting that the stock market is not going to gain in 2018. I think 2 months ago, the level was about 50%, and it is down to about 35%, and that is weighing on consumer confidence with that lower than expected reading today. The market, though, does appear to be shrugging it off. You can see, again, money is rotating into the bonds, which we would think maybe would put a little pressure on equities. But if we pull up the Dow, you can see that we are now close to that high of the day and up 237 points. We had a huge day yesterday, up about 600 points, a little over 600 points on the Dow Jones. It was really an across-the-board move. And one thing that continues to keep me very bullish is that when we get these moves to the upside, it's not the defensive areas that are leading. We're not seeing the rotation. And just to give you maybe a little bit of an indication of what I'm talking about here, if we take a look, for instance, at technology relative to the S&P 500, and I'm going to pull up a, I don't like the candlestick charts. Let's do a line chart, and let's look at 10 years so that we can look at the long-term weekly relative strength in technology. And so since 2013, we had a little bit of relative weakness back in 2012 and 2013. But since then, you can see money continues to pour into the XLK relative to the S&P 500. That makes it difficult for me to get too bearish when money continues to rotate in aggressive fashion. Here are the industrials relative to the S&P 500 continuing to move higher. And we can pull up the consumer discretionaries relative to the S&P 500 after sideways consolidation for a while. You can see the move up. And by the way, back in 2012, remember I was just showing the XLK weakening for about a year between mid 2012 and mid 2013. During that period, consumer discretionary was leading. So you do see rotation not only between defensive areas and aggressive areas, but sometimes we see rotation within the aggressive areas themselves. And right now you can see that the consumer discretionary group on a relative basis is at a new high. And I think that's really pretty bullish. And when we look at some of the retailers, and we talked about this, I think, earlier this week, that does provide us some comfort, I think, in that there are areas of the market where money is rotating to, even when we do see selling and some of the pullbacks. And that money, as long as it rotates and finds aggressive areas of the market, I feel pretty good about the overall condition. So here was the XLY. Of course, we're going to be talking about the XLF later in the What Would You Do section. But here you can see the XLF recently has been pulling back. Another reason why I'll be interested to see what everyone has to say on this. But overall, you can see that we've got a really nice relative uptrend that's been in play really since just before the election back in 2016. Financials have been doing very well. And when we look at a long-term chart of the 10-year Treasury yield, you'll see that the movement in the Treasury yield back here, this is when we bottomed in July and started moving higher. And when we look at that relative strength on the financials, that's exactly when the relative strength started, back in July. So I think the two go hand in hand. If you think that interest rates are going higher, you think the Treasury yield's going to go higher, then I think you want to be part of the financials. Otherwise, if you think that the rates have gone too far, we're going to be falling back, then that obviously could lead to some additional weakness like we have seen here over the past few weeks in the financials. And I can understand why a lot of folks are really nervous about this market, Aaron. I looked at two articles out this morning. One was from Guggenheim Investments chief Scott Minard. I don't know, hopefully I pronounced his name correctly. But he warned that inflation and rate hikes from the Fed will lead to the next market downturn. All right, well, we've already seen some inflation scares, and of course, rate hikes, I think, are pretty much imminent at this point. The Fed's been telling us that for a while, and we're on a rate hike campaign and have been for a period, at least over the last couple of years. But then, right on the heels of that, I read an article from J.P. Morgan, and J.P. Morgan predicts the S&P 500 will rise double digits by the end of 2018, citing valuations and improving fundamentals. And here's a quote. They said, "The market is overreacting to sequential negative narratives such as the inflation scare, rising rates, hawkish Fed, rising deficits, and they are providing a 3,000 target this year." So you've got two prominent companies, Guggenheim and JP Morgan, that are literally looking at the market from opposite angles. So it's not hard to, to fathom the fact that individuals are having problems figuring out what to do with this market right now.
Oh, yeah, absolutely. Well, and I'm still rather bearish. I'm still looking at in correction mode. I still think we're going to be going down further. But I know you're feeling a lot better about the market. So, you get these differing opinions. And, for me, I just err on the side of caution when things are looking a little bit shaky and you are starting to get these mixed messages. To me, that's, with that uncertainty sitting in there, and of course the VIX rising at times, it still makes me nervous about the market. So I get it. I get the people who are feeling that way because I am as well.
Yeah, it's definitely difficult. I mean, I will say that, we've still got, in my opinion, a great bull market underway. Yes, we have pulled back, and yes, it's been scary, but we can't expect the market to be up every day and every week. And that is just about what we saw throughout 2017. We really didn't get any pullbacks. And so I think consolidation is actually doing a lot for the market. You can see the PPO, which was stretched, has pulled back. It's getting closer and closer to centerline support. When you get too stretched on the PPO, as you can see back in prior years, it does tend to lead to periods of consolidation or even outright weakness. So
Yeah.
I'm not surprised what we're seeing so far here in the first quarter of 2018, but I don't think this is going to define the year. I really don't. I think that the relative strength that I was just talking about in all of the aggressive areas of the market, to me, are saying that this is a pause. And the fact that yesterday, when we get this big, rush back into equities, all the money pours right back in. The top four sectors yesterday were the I may not have this in exact order, but technology, industrials, consumer discretionary, and financials all were on the top of the leaderboard, leading that rally yesterday. And that just doesn't smell like a bear market coming.
Oh, I agree with you there. I don't subscribe just yet, at least, to the beginning of a bear market. And I know, Carl is saying that we've kind of been in one now, and that it could very well continue lower. So it'll be interesting to see what happens. But I agree with you. Until we do start seeing that money flow, either completely out of the market or into those areas like gold and the defensive sectors we talk about all the time, that will be interesting. At that point, I think I would start to get a little bit more nervous. But I did just get an intermediate term trend model neutral signal on XLF yesterday. So it'll be an interesting one to talk about for what would you do. That's for sure.
Yeah, and I think the other thing that, and it comes down to personal preference. I like to use, when you go down to the bottom of the screen here, I like to use the log scale. And the log scale is based on percentages as opposed to just points. So, for instance, you can see that 200 point from 800 to 1,000 is much wider than a 200 point from 2,600 to, 200 point move from 2,600 to 2,800, because, for me, it's the difference in percentages. So, in other words, to have a big drop, in order to have an equivalent big drop at today's prices, you would have to lose a lot more points now than you would have to, than you would have lost back in 2011. So when I use this, when I use this particular log scale, you can see that the trend lines here, the channel is still perfectly intact, and I believe, and I hope this doesn't happen, but I still believe that the S&P 500's long-term uptrend remains in play as long as the S&P holds 2,400. Now that would be another 10% from where we are now, and I don't think we're going down there, but who thought, back in early 2016, we were going to, make another trip down below that prior low and, establish this uptrend. So there's a lot going on there. I believe we're in a bull market. I've given my reasons. Of course, I absolutely could be wrong. And we'll see, time will tell. But with that, I'm going to turn it over to you. I'm going to let you take over and go over some of the upgrades and downgrades today.
Absolutely. I'm going to be looking at 2 upgrades and 3 downgrades today. Let's see if I can get this going the right way. All righty. You can see I've been a little busy on my own here. Okay, so I'm going to start with these upgrades right now. I didn't annotate all of them, but I wanted to try and get the important information on there. What I'm noticing really you're going to see on so many charts are these double tops, and they executed and they've gone down, and you're seeing a test of very important support across most of these stocks. And I like the fact that on this one, you got the double top. While I don't think we went all the way down to the minimum downside target, I would have expected maybe down to the 200-day EMA. We did successfully test this $51 area, and we are heading back up. So on an upgrade, I think this looks pretty good. I would just be a little concerned about that 54 area because it does line up right in here on those lows. And I think that's an area that needs to be punctured. And it also happens to coincide with the 20-day EMA. I think it has a really good shot of doing that based on this upgrade. Lam Research was also an upgrade that we got today. And I'm looking at this, and the first thing that really popped out to me is a flag here and then another flag here, although this has gotten pretty messy and even started to widen just a little bit. And I have that PMO sell signal, and it's sitting in overbought territory. But with the upgrade, and I'm going to go ahead and annotate this live for you. I'm going to look at the auto support and resistance. Look at how important this area of overhead resistance actually is. You really need to see that breakout. And then I also would be looking at a breakout from this declining tops trend line. Let's get that in there nicely. And you see we haven't quite got to that either. So it's got two areas of pretty strong overhead resistance to deal with. And we are seeing this PMO sell signal. Granted, it's starting to decelerate. And then you've got the volume pattern. I know we just got an upgrade on this one, but I don't subscribe to the idea that this is a great buy at this point. I think there's too much resistance, and it really needs to get over that. Let's look at some downgrades here. Chesapeake Energy was downgraded. Very ugly chart. I went ahead and went to the weekly because, wow, I'm going to show you the daily. It's pretty darn ugly. Oops, that's the monthly. Let's try that again. And I really like these right here. These are very handy. Our little style buttons. We probably should show people how to do those a little more, because I know I use them all the time. So here we are on a downgrade. We are in this PMO buy signal, but honestly, is this not a surprise? Look at the PMO. It's really been oscillating mostly below the zero line. So that tells you already there's some problems here with the momentum. It's just, it's always seems to be fighting in that negative momentum area, that below zero area. And now with the downgrade, it's not looking too good here. I went in to go to the weekly chart because I really wanted to see what this area of support really looks like. And so that's why I had gone. And let's see if I can get back to there, to the monthly chart, the weekly chart. And, this was a pretty interesting area of support. It really lined up on that gap that we had previously. But this is really the area that I would have expected it to fall to. I think with the downgrade, it certainly could. And then when you see this drop like this and a symmetrical triangle, that's a continuation pattern typically. And you could also make a case for a reverse flag, I think, here. So I would certainly not be looking at this as far as a bottom feeding off of a downgrade. And we can see also with Canadian Solar, we got the downgrade on this one. I don't think it looks quite so bad. I'm going to get my annotation tool out here again for you very quickly and look at some important overhead resistance. Now I'm lining this up with those tops we saw back in the summer and into September. And you can see we didn't even make it up there before turning back down. And if you want to use this top right here, you can see it did poke out just above it, but it has failed since then. And, looking at a downgrade on this and having hit that overhead resistance and started to head back down, while I like the configuration of these EMAs and that PMO rising, again, I'm not looking at this as a possible bottom feed kind of stock. And I think that the downgrades, you can sometimes get in there with those. So I do like to kind of look at downgrades with an eye for a possible move to the upside. after it takes the hit because it got the downgrade. So you can see right now, very, very important support for Kimco. This is also a downgrade. Let's go ahead and look at the weekly chart here. There we go. And how important is this area of support? Well, you can see it managed to stop there. Let's go ahead and annotate what that means. Without even looking at the other half, I'm going to be curious, where does this line up? You can see it lines up with this low, with the high over here. When we went into that correction, it was the area of overhead resistance where it fought back down. You got that double bottom and the nice breakout. Right now, we had that dive. We've managed to hold on to this area of support, but I would be a little concerned. And with that, I'm going to pass it back to you. I know we're going to have our very special guest come on just about now, I would think.
Yeah, we got Grayson Rose with us from StockCharts. And how are you doing this morning, Grayson?
I am good. How are you guys doing? It's good to be here with you.
We're awesome.
Yes, as always.
Good. Well, we've got some exciting stuff to talk about today.
All right. Well, I do too. I got my vacation coming up, so I can talk about that for an hour and a half.
Oh, I know. You're already bragging about that. I mean, do we really need you to brag about that?
I'm sorry. I don't want to take away from your time. I'll let you get going.
I don't need to hear about you on vacation.
Hey, this is exciting.
You in a swimsuit, is that the image that I need?
No, that is not. No. That's not where I was going to go with that. I was thinking golf. I was thinking golf course, okay? I was thinking Universal Studios. I was not thinking.
Right. Okay, well, we got some better imagery, hopefully, for people coming up here. I am thrilled to be here today because we're introducing something very, very special. Now, for those of you who have sort of been following us for a little while, if you've been paying attention, we've been hinting at this, especially if you follow our Chart Watchers newsletter, which, by the way, all of you should go sign up for. And if you follow the Market Watcher show, you probably noticed some changes to that page, some logos appearing on it, maybe a couple mentions about this. But I'm here today to introduce what we are calling StockCharts TV. So StockCharts TV is a sort of a new product, new offering that we're going to be launching on April 2nd. That's this coming Monday. We are going live on April 2nd. So StockCharts TV is basically Market Watchers Live on steroids. We've had a fantastic run with Market Watchers Live. We've been really happy with this model, and we want to do more. We've had a lot of people that are asking us for even more. And we can do more, so we're going to do that. So, StockCharts TV coming on Monday. StockCharts TV is going to be the only 24/7 video streaming channel, really a web TV channel, devoted exclusively to financial charting, technical analysis, and current market commentary from a huge list of the web's top technical experts. So, for a long time, we've had different shows and guests and things. We've had Tom and Aaron, obviously, two of our top technicians on here giving their thoughts on the market, sharing their outlook. We're expanding that. We're expanding that beyond one show. We're going to have a 24/7 stream that's always got something running. There's always going to be content. And on top of that, we're going to have multiple live shows. So for those of you who are thinking, oh no, I hope Market Watchers Live doesn't disappear. Market Watchers Live is staying right where it is. It's going to be Monday through Friday, just like it's always been, with Tom and Aaron and their special guests and everything. It's going to be at the same time. We're adding to that, though. We're also going to add in a live show from Arthur Hill. That's coming in a couple weeks. And we're going to add in a live show from Greg Schnell. That's also coming in a couple weeks. And we got more stuff beyond that, too. So as this thing grows, as the channel gets built out, we're going to keep adding live shows. We're going to keep things fresh and interesting always. There's going to be lots and lots of changes for you to always see. On top of that, we're going to have lots of frequent guest appearances by some really special people. We've had great guest appearances on Market Watchers Live for quite some time. And with more live shows, more streaming time, more airtime, if you will, that's only going to grow. So we're going to have industry experts, different distinguished technicians, people that have created indicators, all that kind of thing. Published authors and lots of different financial professionals coming on to talk to you, share their thoughts on the market, share their expertise. So by building out this 24/7 stream, building out additional live shows, we can really offer you even more. More people, more time, lots of good stuff. So like I said, 24/7 content. Let's talk about this for a second. Our goal with StockCharts TV is to provide insightful, educational, and entertaining financial programming online. That's the key. We want to take this online so that you can watch it wherever you are, no matter where you are. 24 hours a day, 7 days a week. We want to have something running at all times. We've got tons of content to share with you. There's always an opinion. There's always a video. And we want to share that with you on StockCharts TV. Like I said, 24 hours a day, 7 days a week. It's a big hurdle, but we've done a fantastic job with it. Our video production team here behind the scenes has been working really, really hard for many, many months on this. And we're finally ready to go live on Monday. So very exciting stuff. But again, insightful, educational, and entertaining. We don't want to do stuff that's dry. We don't want to do stuff that's just fluffy and entertaining, but it's not of any value. We're really trying to create valuable content that's also fun to watch. It's engaging, and it's going to be a great resource for you guys. With the various live shows, we've got pre-recorded content. We're going to have highlights from past chart cons, for example. Lots of really, really great stuff coming in this 24/7 stream.
And it's free.
Free. It's totally free to watch. Yeah, we're not here trying to charge you for the content or anything. We want to provide you this content. We want you to watch it and enjoy it. It's totally free to watch. So speaking of free to watch, how are you going to watch it? There are a couple different ways that you can watch StockCharts TV. Now, the first one obviously is online at StockCharts.com. All of you who are currently watching Market Watchers Live, listening to us right now, it's going to be very, very similar. It's the same platform. It's just extended to 24/7, so it never shuts off. So you're going to be able to watch online at StockCharts.com. We're also going to be streaming to YouTube. So some of you may be watching on Facebook. We've been streaming on Facebook Live for a little while. We want to actually reserve Facebook for more sort of engagement with our viewers. You can post comments. You can have sort of highlight videos and things like that on the Facebook page. So we're going to actually get away from Facebook Live, and we're going to stream instead to YouTube. So YouTube is going to become sort of this bigger video resource for us. So if you want to go watch live there, you'll also have different sort of highlight clips and things like that and previous shows that are going to be archived there for a little while. So the YouTube channel is going to get built out. That's going to be the official StockCharts YouTube channel, which is already up and running. Go check that out today. And the third and final way to watch, which I think is the most exciting, on the app. So we've developed an official StockCharts TV app. It's available now. You can go to the App Store or Google Play. You can download it if you're on an iOS device. If you're on an Apple, iPhone or an iPad or anything, you can go download it from the App Store. If you're on an Android device, you can get it from the Google Play Store. Again, free to download, free to watch. This is just going to make it much easier for you if you're running out the door, but you want to follow StockCharts TV in the taxi on your way to work or something like that. You can always catch it on the app. So it's a really, really easy way to follow StockCharts TV. So I would definitely encourage all of you to go download the app. Again, totally free. We're not charging for any of this. We just want to provide you a great, valuable resource as easily as we can. So the app is going to be definitely a great platform to watch StockCharts TV. Now, last point here. Follow us. This whole thing is all about engaging with you guys. It's all about engaging with the viewers. We're doing this for you. We want to provide you guys with content, and we want to hear from you. We've had a great run with the polls and the questions and everything that you guys submit here on the site for Market Watchers Live. That's been fantastic. We want to build that out even more. So we've set up an official Twitter handle for StockCharts TV. You can follow us at StockCharts TV on Twitter. We'll be using that more and more in the coming weeks and months. We've set up a Facebook page. You can go give us a like. StockCharts TV is the Facebook name, Facebook page. So go check that out on Facebook. And like I said, YouTube is going to become a bigger and bigger resource for us. We're going to be posting a lot more content there. And when StockCharts TV launches on Monday, on April 2nd, you'll actually be able to stream live from YouTube if you'd like. So you can follow us on YouTube, StockCharts.com, youtube.com/StockCharts.com, or you can just give it a search for StockCharts. You'll find it. And again, download the app. I think you guys will really love the app. It's a great resource. We're very, very excited about that. It's one click right from your phone, and you're watching StockCharts TV. It pulls it up right away, and you can just tune into the stream. So all of this, like I said, coming on Monday. It'll kick off with Market Watchers Live in the morning on Monday, and from there we're going to be running 24/7. It's just gonna keep on running from there, never gonna end. And another great thing I will say too, Market Watchers Live has been a huge success. We've been really thrilled with the response to that show. And so one of the great things about StockCharts TV is that because we're running a 24/7 stream, Market Watchers Live can play actually later in the day. So we're going to actually run the Market Watchers Live show, the live version, right in the morning, and it's normally scheduled time that we've been at for a few months now. We're also going to do a follow-up, a replay of the show later in the day on StockCharts TV. So if you miss the stream, that's the live stream, that's totally fine. You can just tune into StockCharts TV later in the day. We'll have a schedule posted actually on the page, so you'll be able to see when everything is going to play and all of the shows that are going to be scheduled there. And on top of that, it is this live stream platform, which if you haven't figured out, you can actually scrub back in time. There's sort of a little bubble there, a little slider at the bottom of the video player, and you can actually scrub back in time, back and forth. If you want to catch something again, you want to hear something that Tom or Aaron said, follow up on it. You can always scrub back in time. So there are a bunch of different ways that this live stream platform makes it easy for you to watch the content. But really exciting stuff. It's coming on Monday. We're launching live. Hope you'll all be with us. Remember to follow us and download the app. And we just can't wait to see where this thing goes. It's going to be really, really big.
All right. A couple of questions too.
Sure.
One was, if you wanted to go back and just see an archive from one of the shows, are the archives still going to be available on YouTube?
Yes. So we will archive shows. We're probably going to only archive about a week of shows. After that, the content, when you're talking about what the market's doing this morning, generally the content, kind of loses its relevance pretty quickly. That said, we will clip out, if we have a special guest come on, like we had Mark Chaikin on the other week, that's going to get clipped out and we'll archive that separately. So those sort of timeless interviews and things like that, those will be archived for a longer period of time. The show will be archived for about a week. So if you want to go back and review something, maybe it's Friday, you remember something from Tuesday that you want to go hear again, you can do that. They're not going to be up for, years to come off into the future, but they will be up for for about a week while that content is still relevant. So
and then what time exactly? Somebody wanted to know exactly what time we're starting on Monday.
We are starting right at this normal time. We're starting at noon Eastern. It's going to start basically with the Market Watchers Live show. So that'll we'll go live for the Market Watchers Live show, and we'll never end. It's just going to keep going live.
Wow.
So tune in. You can tune in on Monday at noon Eastern, just as if you're watching the Market Watchers Live show, and you can keep on watching after that.
Excellent.
Okay, question, Grayson.
Oh, not from you, Boley.
Yeah, I got a question. Okay, so you're going to replay our show later in the day, correct?
Yep.
So are you giving Aaron and I an opportunity, like a little button where we can go back and edit comments that have turned out?
There you go.
Yeah, we'll give you the ability to change out your charts depending on what happens. No.
So I think we should get residuals too. Every time it plays.
Yeah, that'd be kind of fun if we had. We stop the feed and Tom's face pops up and he says, "Okay, now what I meant to say here was."
Yeah, I forgot to add that if it holds support, it could reverse. I need to have that little playback button, edit button.
We'll have the video team work on that. We'll see.
That's awesome. No, this is really good news, and I'm sure everybody's excited by it. There's a lot of great information that's going to be shared through StockCharts TV, and I think it's another great step in direction of educating and providing knowledge and sharing a lot of our experiences over the years.
I think so too.
Yeah.
All right, guys, I'm out. Remember, everyone, go download the app. I think you'll love the StockCharts TV app. It's going to be make it a lot easier to follow the content no matter where you are. And then we'll see you on Monday. Really exciting.
Appreciate it. Thanks so much, Grayson.
See ya.
All right, there he goes, Mr. Grayson Rose. Wow, that's an exciting announcement. I mean, I know this has been in the works for a while. This just doesn't happen overnight. And there have been, as Grayson mentioned, a lot of people on the video team that have been working, on the production of this. And so it's an exciting announcement. Can't wait until, we are able to jump in. Of course, I wonder if they did this on purpose and they looked at my calendar and said, hey, he's on vacation. Let's start it while he's gone.
Yeah, exactly. Yeah, that's kind of interesting. Actually, somebody was saying, hey, does this mean we get to see Aaron and Tom live and not just hear them? And they said it would be awesome. I don't know how awesome it would be to see Tom in the mornings, but the afternoon. But
Yeah.
I have to say, it's early-ish in the morning on the West Coast. And now I'm like, oh my gosh, I have to brush my hair.
I have I don't know, but I have a face for radio. So this is probably best that we not go into this whole video thing, but we'll see.
Yes. Well, of course, you'll see us all in August.
All right. Well, I know it's time to move on. So why don't we get into our next segment, which is this is an interesting title. Don't ignore this chart. Those of you who have been at StockCharts for a while know that we have a blog here at StockCharts. Don't ignore this chart. And I know Greg Schnell and Arthur Hill spend a great deal of time looking for anything interesting that you can show on a chart. And literally, when they post those blog articles and it comes across, don't ignore this chart, you really shouldn't ignore this chart, because from a technical perspective, those charts are saying something. So I thought, from our standpoint, we're going to pull up some charts that we feel like you probably shouldn't ignore, and maybe highlight some things that Greg and Arthur have gone over in the past. So I'm going to turn it over and let you start, Aaron, if you're ready.
Of course.
What do you have?
Let's see here. Okay, I'm going to go over here. So what I did is I pulled out a couple of the blog articles that either Greg or Arthur did, and they gave us a chart to look at, and they told us about it. And then what I did is I went in and looked at, well, what happened next. Were they right? Were they wrong? Although there's no right and wrong, in my opinion. You have your analysis, and it is what it is. But I thought I would pull up a few of them. And the first one I was going to look at is one that Greg wrote back in February 25th about Micron. And I know this one's always very interesting for everybody. We're all wondering about it. So let's think about it back in time. We'd had the correction already. We were heading back up, and he was pointing out the fact that we had that breakout. We had nice volume coming on this. So what actually ended up happening with this one? So I went in, you can click the chart, and this you can do in any of the blogs if they are live or clickable. Most of them are going to be clickable. I think that's a word, clickable. All right, so here is what he had done, and you can see we got that breakout just as we were expecting at that point. Of course, it has pulled back since then, but look at the volume that came in back here on that move up. I think that was probably an interesting period of time to make some consideration as far as whether it was going to continue higher, poking out that high and then closing all the way down here. But I thought that one was pretty interesting. So I decided, though, what am I looking at because we all look at them differently. And so I just went ahead and took his chart and annotated it a bit here. And as I said, we got that breakout, but notice we hit this area of support and we're bouncing off of it now. So I think we're now in that space where we could look for a move on Micron to go back up and test those highs back here at $63. So I thought that one was very interesting. And another one, because it did come up on, I did see it in the comments as well, is GE. And we all know the sad story of GE, at least when you look at their chart. It's a pretty sad story. And Greg had written about this back in November of last year. And of course, we were already seeing some very bad things happening with GE after the announcements came out. And so it was interesting to see that he pulled this chart and was looking at it. And he had some great comments to say about it, too, about the fact that, when you're looking at this kind of a stock, an essential sort of that's been there forever, And then you see that it hasn't really done anything over the last 20 years, really, or the last, I think, 10, 15 that he's got 10 years here. You know, we were down here back in 98 and we're kind of the same area. So GE hasn't done that well, but I decided that I would take a look and see what's been going on with the GE. So I did go ahead and do the chart for it. And let's go back. Wow, that was interesting. Okay. Where did I put GE? There it is. I changed the name of that chart list. So here's GE. And I went ahead and pulled it up on a monthly chart because, you know, honestly, when we're looking at this sort of a waterfall effect over the past year, there is no way to really look on a daily chart and see, you know, where your support is. And honestly, I think even the weekly chart, you really miss out on support levels. And so I had gone ahead and pulled this out to look at, and I thought I had annotated it, but it doesn't look like I did. So I'll just do that very quickly, and then I'm going to pass it back to you, Tom. And then Disney, I was going to look at Disney real quick. Really interesting, right? We're sitting right now on this area of support for GE. And I know the question is at this point, everybody's like, okay, well, is this that point where we're going to get that bounce? And how many times have we been saying this over this time? There was a really important area of support. You could say even when all of this started to go down, you know, we hit this area of support. It's just been losing. And you can see with the monthly PMO, it's just still in free fall. OBV, the volume has been negative all the way, you know, for most of the year. Every single month, it's been negative. So I wouldn't be bottom feeding on this. I mean, I can see how it's very enticing at this point because it has been, you know, it's GE. You want to get into something at blue chip, right? This seems like someplace you'd want to eventually get back in, and I still don't see it. I'm still not seeing it. And then the last one I was going to look at very quickly is, and I'm going to go here so you can see how to find the blog. And I was going to also look at Disney, and I think that one, yep, right here. Investors cut the cord on Disney. And so Arthur Hill wrote about this breakdown and the fact that we're already seeing this. I'm looking at, it's kind of a weird looking double top, but I could still say that. And I see how it was hitting that support or confirmation line at this point. Also a symmetrical triangle, it looks like is what he had actually annotated. That's a continuation pattern of this downtrend. So we would expect it to move lower. And so, of course, what I did was go, this one was not clickable. Sometimes they are not. So I went ahead and made my own. And what happened? Yeah, it did break down below that confirmation line. It does seem to be trying to come back up here right now, Disney is. I think that's going to be pretty strong overhead resistance. And, you know, I don't like the fact that, again, this could be you know, sort of a complex double top. I'm trying to think of the actual name for that, but we could get that drop. And then even if you're looking at the small side of the height of this pattern, we still really haven't gotten down to the level we need to. I would be looking at a bigger move. I would be looking for a test all the way down here at that support level. If we see a failure here at this overhead resistance, I think it's going to be a little difficult for Disney. And so those were the ones I was looking at, but I adore the Don't Ignore This Chart blog because it is always very concise. It's one chart with about 5 or 6 sentences that really punch, and then, you know, you get a pretty interesting look that way. So which ones were especially interesting to you?
All right, well, I pulled up, actually went back a couple months, and, you know, a lot of times these Don't Ignore This Chart blog articles will talk about one specific stock and be very quick, like you said. And other times it's a little bit more of an allocation strategy. I know there are probably a lot of listeners who are contemplating or are always contemplating, you know, how much into stocks, how much into bonds, and that sort of thing. And so I thought this article that Arthur had done back in January, The Mother of All Reversals is Building in the Bond Market, I thought was really an interesting article. And at the time, the 10-year Treasury yield was at 2.63. So this was a couple of months ago. But and I think what Arthur astutely points out here is that we've got a double bottom. This goes back all the way into the early 80s, this downtrend that we've been talking about. And I know for me personally, I've never really invested in a market where we have a long-term trend higher in interest rates. The whole time I've been investing, you get pops in the yield, but for the most part, we have been declining for the past, 40, well, almost 40 years, 30, 36, 37 years. So it does look to me, though, like, we're not going to go below zero. We do have a double bottom in here. And so what Arthur pointed out was simply watching this 3% area that we've talked about here on the show. And so I completely agree with his analysis here that we could be in for a different stock market, and eventually interest rates get to a point where it does slow the economy. Now, I think we're down near historic lows. I don't believe interest rates are a problem at this point, but I do think eventually they could become a problem. And the first sign of them really breaking out and starting an uptrend would be this move over 3.0%, 3%. So I thought that this was an interesting article. Anytime, by the way, this was back in January. If you click on the Don't Ignore This chart, you can see right here at the top, blog archives. You click on that, you can see you can go all the way back to 2009 if you'd like. Hopefully, you wouldn't hold us to too high a standard going back 8 or 9 years. But just to show you that you could go back and pull up articles in the past. So throughout this year, I had just gone back into January. And the main reason I was looking back there is that's when the stock market topped. And we just started going through a consolidation. And it was shortly after that that the 10-year Treasury yield topped and went through a consolidation, as the two tend to kind of go, at least in terms of short term, the two tend to go hand in hand. So anyway, I thought that was a really interesting article. I did want to pull up a couple of charts that I thought looked kind of interesting, maybe share my own Don't Ignore This chart. So let me give you a couple of these. One in particular, I may have mentioned this one recently. Gambling stocks doing well today. SGMS not following suit to the upside. When I look at the daily chart, I'm not really overly excited about it, but you have to keep in mind the context of these moves to the upside. And Scientific Games, SGMS, went through a huge move to the upside. And at the top, you can see both of these last two highs in early December and then again in January. Both came with the weekly PPO rolling over. And we have nearly made it all the way back to test centerline, which we had not seen since really this entire move to the upside began back in late summer of 2016. So I think this is a stock that if gambling stocks do well, I believe SGMS could be in a position where coming off the weakness and consolidating for a while and allowing that weekly PPO to reset back near the center line, I think this is a stock that I would not ignore going forward. I think if gambling stocks do well, I could see this one beginning to outperform again on a relative basis. Another stock, I mentioned this one earlier, Red Hat. They came out with great earnings. We're talking about a software group that has been on fire on a relative basis, one of the leading areas of the market, and Red Hat did not disappoint. Now, in the near term, you can see that the PPO was going down. We got this breakout, massive volume, and so far we've got this black candle, and that bothers me in the near term. So I would not be surprised to see this gap fill, possibly even moving back into the mid-140s, perhaps getting this 50-day test to reset the PPO. So I think this is one that I would continue to keep on my radar. I definitely would not ignore this chart. And then actually, I'm going to go ahead and maybe do this relative chart as well, just to show you that here's the software group, which even though the market went back, we just saw the Dow Jones break on a closing basis below its February low. You can see that the software index never got close to its February low. Here is Red Hat on a relative basis to software, clearly one of the best performers in this space. Here's Red Hat versus the S&P 500. If you want to beat the S&P 500, you want to do it with stocks like this. And then you've got software relative to the S&P just recently breaking out again. Despite all of the panic and all the high volatility that we've seen, software continues to be one of the best areas of the market, and Red Hat is one of the top stocks in that space. So that is essentially what I wanted to go over. Just a couple of stocks there not to ignore. One final one just very quickly is Tesla, and I'm watching this. And it's funny because I was talking to Arthur before the show today and asking him, trying to find some support for possibly thinking about going long on Tesla. And you might look at this and say, why in the heck? You know, big red candle today, down $12. Looks like it's breaking down. Volume's picking up. Well, for me, it's about the weekly chart and realizing that the sideways consolidation, the breakout occurred at 280. So we haven't gone back and tested that 280 level, and we're starting to get close. But Arthur wasn't biting.
No, he wasn't.
He did not like Tesla, so I may have to, if I decide to go into this one, I have to go out on my own. And I know we've got seasonality coming up. I don't want to spend too much time on seasonality because seasonality is a topic that I'm going to talk about on Thursday for April. But if I pull this up and just click on the, whoops, that's not what I wanted. I think Tesla's seasonality is one of the craziest things. You've got April, May, and June. Look at the average gains over the last 9 years. And then maybe taking it one step further, this is maybe one of the craziest. This could be the craziest seasonality chart. Automobiles. And over the last 19 years, look at April.
That's insane.
I mean, it is crazy. All of a sudden, April is like this month where autos think that they're the internet stuff, you know, the internet group or something. You look across here, and outside of April, autos over the last 19 years have averaged falling more than 5% in the other 11 months and average gaining 9.3% in April. April's next week. So I don't know if that means autos are going to take off, but it's certainly worth at least mentioning the strength there. And with that, let's turn it over. Well, actually, let's give, I guess, a quick summary of what we did there with the Don't Ignore This chart. Yep. I do, again, like you said at the beginning, I do want to give a shout out to Arthur and to Greg. They do great work there. And a lot of times it is just very quick little nuggets that they give on these blog articles. And I think that the articles come out either daily or almost daily. So a lot of good information, a lot of good ideas. You want to check out that blog. And all of these blogs, by the way, you can subscribe for free, most of them for free, by going to the bottom of the article, typing in your email address, and simply hitting the subscribe button. You won't get spammed, nothing like that. You'll actually just have the blog articles sent to your email as soon as they're published. So it'll save you a lot of time.
Yep. And I think we should give you a little bit of credit, Tom, because a lot of those articles you did write before Market Watchers Live. I think you contributed quite a bit to that blog, if I recall.
Yeah, I actually enjoyed it because almost every day you can find something that looks really interesting from a technical perspective, or as I showed you with Arthur's post, you know, looking at different markets. There's always something going on somewhere that is interesting, and I think Arthur and Greg do a great job. I enjoyed it, like I said, doing it. It was just a matter of once the show started, not really having the time to get into it like I did before. But yeah, it's a great blog, and I would highly recommend it.
Absolutely. All right. Well, with that, let's go ahead and get ourselves into that 10 and 10.
All right.
And let's see here. I will share what we're showing here right now. And it'll be here. All right. So far, and I apologize if I didn't get yours in, but right now we do have about 38 to 40 to look at here to make our choices from. And what I thought I would do is just, rather than do RRG, since there are so many, I'm going to show you a candle glance, and here's how you can change what you want to look at. So I'm going to just look for the last 2 months and give you just a quick feel for the different ones that you have picked. But this is a great way to go through and you can adjust your time frame, because if you recall, the one that I use is only a 2-day 10-minute bar chart. So it's a lot different than obviously looking at the last 2 months. So I thought this one was pretty interesting just to see the various, setups right now over the last 2 months for some of these. So very interesting. There's Tesla in there. We did have that requested. So they kind of got that one already, didn't they?
They did.
All righty. So RRG, though, I will just show you where we're sitting. And interestingly, I always find it interesting that, the requests for 10 and 10 tend to be in that leading category and improving category, or just weakening. So we don't usually get a whole lot in that bottom zone. So anyway, let's get started with Kohl's KSS. And just to let all of you know, I do try not to repeat myself, on these every week, but a lot of times some of them are just so popular and so many people want to see them. I'm now watching the polling in the question box. So if you want to see one of the requested symbols that are already out there, go ahead and like it, because the one with the most likes will automatically be looked at in the 10 and 10.
All right. Well, here to start off, we got Kohl's. You can see the beautiful uptrend from the November low through mid-January. Since then, we've been consolidating, I think, in a very bullish ascending triangle. I also could draw maybe a line coming across here on this breakout at about $58. I think that Kohl's worst case scenario is sitting in a trading range between about 58 and 68. But I do like this these ascending lows that are coming in. So I'm looking for a breakout on Kohl's above 68. High volume would confirm that breakout.
All righty. Next one, the most popular request right now was Square, SQ.
Oh, wow.
Lots of people want to see that one.
Yeah, I was expecting Facebook or Apple. That tends to be one of the big ones. But Square's been a great performer. I actually really like the stock. It did go through a period of consolidation. It made a huge move. It needed to consolidate for a while. But when it finally made the breakout above 50, check out the volume. I was just talking about how, confirming volume, want to look for that confirming volume on these moves. And I think this is a perfect illustration right here. It was the biggest volume that we had seen for the most part throughout this consolidation period. Had a beautiful move from 45 and change, closing above 50, taking out that prior move. And then we moved up to 58, pulled back. And notice during the pullback, when the market was selling off a little bit, we got close to price support, hit that rising 20-day moving average, and now trying to bounce off of it. I actually think that that's not what I wanted to do. I think what we're looking at is a trading range now on Square between 50 and 58. So the closer it gets to 50, the more I like it.
All right. One of the other things I noticed too is lots of cyclicals and technology sector stocks. That's over half of what everybody requested. So I found that pretty interesting too. Next one will be Tech, T-E-K, Tech Resources. Our only materials sector request.
T-E-K?
T-E-C-K.
Oh, T-E-C-K. Okay.
Sorry about that.
It's all right. T-E-C-K, double top, recently breaking down here, but the volume was not heavy on this breakdown. So I think what I am going to do here, let's take a look at the weekly. This could be a little bit of a, it doesn't really show there. I was thinking about maybe a bullish wedge, but I think what it does show is that this pullback is coming back to a key area of support on the long-term chart. Right there, you can see all these tops coming across. And actually off the uptrend, I see a left shoulder, neckline, head, neckline, right shoulder, and a breakout. So I would look for this to measure in time to about 37, 38. So I like this pullback on TECK. Maybe you want to give it a little bit of room. You could go down the 50-week moving average. But I think if you close much below 25, I would start to get a little nervous in the near term, because that would maybe suggest we'll get that 50-week test. But I think this is a nice-looking chart. And, again, I think that the pattern here with this possible inverse head and shoulder breakout is particularly bullish for me.
All righty. See, the next one I have the only consumer staples request, ABEV Ambev. Brewer.
ABEV. All right, let's go back to the daily. Yeah, I like the action here on ABEV Ambev. We did clear some overhead price resistance, really a couple areas right there, looking back at that low. And then we did gap up one day just above. So I would say that's a pretty important range that we broke above. And again, look at the volume coming in as we made the breakout. Volume was accelerating, which is what I want to see. PPO was strong. We pulled back. We held the rising 20. Right now, it looks to me like the 20-day EMA is what you want to keep an eye on. That's what's been holding, and that's what makes sense to hold given the strength in the PPO at the most recent price high.
All right. Let's see. The next one I have for you in the energy space, Ion Geophysical, IO.
All right, IO. Well, it looks like maybe off of the uptrend, we might be starting the right side of a cup, which I like. So here was your uptrend. So let's draw that in there. So in order to have a meaningful cup and handle, you do need a prior uptrend in play, which I think we have here. And then from there, I would be looking at perhaps a parabola starting there, coming down here, and for now, back up there. So you can kind of get this feel of a cup that's turning back to the upside. Also, today's volume already 250,000 shares. So this is going to be a pretty strong volume day, and that's what you want to see on the right side of the cup. You want to see the volume start to build. So I like this one. I think it's bullish. It is definitely volatile, as you can see on the chart. I mean, it moves all over the place. So not for everyone, but I do think we're going to see higher prices down the road.
All righty. Next one for our Canadian friends, and our only one from the utilities sector, NPI.TO, Northland Power.
All right, well, I'm not a big fan of utilities. This one, it looks pretty good so far. I would probably, as long as I'm in this one, assuming it's a shorter term trade or maybe an intermediate term trade, is I would be watching for the rising 20-day moving average to hold. And when that fails, I would probably be out. So as long as it continues to stay above that, I'm fine. But we can see what happens when we get on these moves to the upside and then we fail to hold the 20. You can kind of see what happens here. We break out above, we fail to hold, back down, break out above, back down. We do have an uptrend in play from a price resistance perspective. If you're looking to exit on strength, I think the first key area is going to be up close to 2340, and then the second will be more like 2370. It's not a big mover, by the way. Looking back over the last 6 months, 2140 to 2440 is the range. So, and that's typical of many of the utilities.
All right. The next one I have for you is TNDM. And where did I put that one? That is Tandem Diabetes in the healthcare sector.
Yeah, I like the volume that's been coming up, and we do have a breakout today. There is one area of overhead resistance that I'd pay attention to. Look for a possible reversing candle at gap resistance. So if you come up like we saw back at the beginning of the March, if we see these long tails to the top side above the resistance at 470 with a failure to break above, that might be a short-term sell signal. But I like the volume trends. I like the fact that we've been bouncing off the rising 20-day. So there's a lot to like here. I wouldn't be afraid to take some profits, though, especially if that reversing candle shows up near that gap resistance.
All right. Next one, Red Hat, RHT.
All right, I've pulled that one up a couple of times today. I don't know if we want to.
We can do, how about Watt, W-A-T-T.
Yeah, I'd rather do that rather than spend more time on the same stock. I love Red Hat. It's in a great area. But Watt is a little more interesting because we did go all the way down to the tail after that huge gap up, and it held so far. I think that's a real big level right there because look at the volume that came in. So we gapped up to about 17 and change, and intraday, that's where the buyers came in, right at about 15, maybe just above 15. And when we looked 2 days ago, that's where we got down to on that low before we rallied yesterday. If we fail to hold this low, and I'm going to go ahead and just save this as is. I want to pull up the inspector button, though, because I'd really like to see what this price level is. And you can click on this inspect right here and then drag this. You can get actual intraday prices. So on December 27th, we gapped up to 1735. Our low that day was 1530, and then our close 2 days ago, 15 and a quarter with an intraday low of 1512. I would be careful if 1512 is lost to the downside, or if we close below 15 and a quarter, especially if the volume picks up. I think we could rally from here, though. I think this is an interesting reward to risk candidate.
All right. Let's see, the next one is JD.com. JD. Interesting support level right now. I honestly don't really care for it, though.
Yeah, I'm still looking at stocks with a bullish bias. So that does, when I look at the short term, the gap down, heavy volume, failure at the 20, pullback, I would agree with you. PPO looks weak. I mean, there's a lot to not like about it. Even volume trends haven't been great. But I'm going to err on the side of bullishness. There is a gap right here back in mid-December at about 40 and a half. and we've gone back, almost filled it. Looks like we just about got there on the low 2 days ago. You got to keep your line in the sand. For me, it's probably around 40 and a quarter to 40 and a half. If the stock can't hold that level, I'd be real careful. But I wouldn't be surprised to see JD begin to rally from this area. Maybe not today, but I'm just saying we could consolidate here and then make a rally maybe toward earnings.
All right, the last one, United Airlines, UAL.
All right, UAL. I'm going to pull up the wheel.
When you do that sigh when the chart comes up.
It's like usually when I do that, I just really don't have a strong opinion one way or the other. And that's even looking at the weekly. I mean, when you look at this over the last 15 months, it's been sideways. We make these big moves to the upside. We fail. We come back down on a breakdown below the moving averages, right back up above, and now we're back down. It's like, and look at the PPO just hovering right at the center line. The PPO doesn't know which way to go either. So it's just telling you that there's not really a whole lot of momentum in the stock. If I had to pick something, just again, because I'm bullish, I'd be on the long side. Here's a nice uptrend. Maybe consider all of this a little bit of sideways consolidation. And since I have to put some sort of annotation on this chart, I'm going to do it like this. So let's just recognize that we do have an uptrend in play. And from there, I'm going to annotate what could be a kind of, I don't like this length of a triangle after, the triangle length is almost as long as the uptrend, which is kind of weird. So I'm just kind of mixed. I don't really have a strong opinion, but if I had to take a side, I would probably take the bullish side with maybe the trend line, a test of the trend line being best entry.
All right. And that completes the 10 and 10. And here are our symbols. I will do my best to get those up into the Market Watchers live chart list, which you can find from the blogs page. Just go to the Market Watchers live blog and click on it, and our chart list with all of our 10 and 10 for the past few days will be there in that chart list. The link is right there at the top. So let's go ahead and move forward. And I think it's that time.
It is.
ChartCon, everybody, is coming up. Let's get over here. Reducing risk in uncharted waters. So in August, we're having our big ChartCon, our StockCharts convention, and it is online. So we will be there live, and all of you can join us online. It'll be very similar to what you're seeing now, only you'll actually see us standing on a stage, from what I understand, like we did last time. And you're going to really get some interesting information out of it with reducing risk. But I do want to point out real quick is that our VIP packages, if you do want to come join us in person, and what an opportunity, because it's only a handful of VIPs that are there, and you'll get one-on-one time pretty much with everybody, I think, at one point or another, and have time to talk to us, and we can talk shop, which I absolutely love to do. So I would love for you to join us, and I know everybody else would like to see you as well. So you can do just that weekend, and if you want to add on, though, a cruise to Alaska after that, most of us are going on that cruise. So again, more time to interact or hide from whoever you don't want to talk to after all of this time. But it closes on March 31st for the VIP packages. So that's like at the end of the week. So go talk to that significant other, talk them into a cruise, and then you can get that added benefit on the side to go to ChartCon and meet all of us. So that's all I would have to say about ChartCon. So go ahead, and you've already seen the link, and go check it out.
Yeah, the only thing is I may have to stow away my featured shorts and golf shirt attire for a trip to Alaska. Even though it is summertime, I'm sure it still can be a little chilly.
Oh, I'm sure for us, it will be very cold, in my opinion. I'll be breaking out the sweaters and the jackets, and yeah, no swimsuits. And honestly, even if we could wear them with all of you hanging around, I would not do it.
And I've lived such a sheltered life. I know the first time I went out to Seattle back, I think it was in 2011, the first ChartCon. And when I packed, I mean, I wasn't thinking. I didn't look ahead to see the weather forecast or anything. It was August. It was middle of summer. So, of course, I'm only going to pack shorts, right?
Right.
But I got out there in the morning. Of course, I always have to make my morning Starbucks run, which in Seattle, you can find them everywhere. You just walk out to the hotel and there's a Starbucks somewhere.
And probably one across the street, too.
Yeah, but I had to actually walk a block. I was a block away. So I had to walk a block. I went out the first morning I was there. It was 42 degrees in August. And I'm walking out there in shorts and a golf shirt. Probably people there thought I was nuts, which, hey,
Oh, they probably thought you were from Canada or something. From cold weather, because, wow, 42. Woo, it's warm.
Yeah, having a party out here in it. Anyhow, yeah.
All right, enough.
Say though, ChartCon is great. It's great to get together with everybody, and if you're on the fence, jump over the fence. I mean, you definitely want to join.
Do it. Just do it. And like I said, that cost, I believe, includes your significant other, and that's honestly for a week to Alaska, and just about everything gets covered, I think, in that price too. So check it out before it goes away. All right, so let's get started with a market update. And I'm going to go into the candle glance for us. And here you go. This is a 2-day, so we can get an idea of exactly what's been going on so far in the market. Look at this really nice rising trend we have on the Dow, and really all of them since about, 11:30 yesterday. So shortly after we went on air, I think a little bit before. And you can see that since then, it's just been on a nice tear. We took those pauses, and it does look pretty good in the short term, I have to say. But the NASDAQ not really following through on its rise like we saw with the Dow. And Russell 2000, as you pointed out earlier, Tom, is not even flat now. It's starting to head back down, and also in the negative like the NASDAQ is as well. Treasury yields have been slowly moving down since the beginning of the day, currently reading at 28.08. UUP, big gap up, but is pulling back some of those gains. And consequently, we saw a big gap down on gold, and it's now starting to take back some of those losses. We have the VIX still rather high. It's been going down, though, since we had that. You can see it's pretty much right on top of that. When we started to see that rising trend start, the declining trend on the VIX began, and we're now looking at readings just above 20. So while somewhat elevated, certainly not where it was at about 24 and a half yesterday. Let's move on here to our market summary. Give you a quick peek at what's going on as far as our sectors and industry groups go. And you can see utilities today leading up over 1.25% right now as far as that ETF, but followed by consumer staples, industrials, materials. So we can see right now in the very short term some rotation into these defensive areas of the market. So we are getting this rise, but in the very short term, we're seeing it in some of these defensive areas, something to consider. Technology is the only spider right now in the negative, and it is down almost 0.5% right now. As far as U.S. industries, utilities, REITs, and telecoms are leading. And computer technology, gold, as we can see, gold is now the big laggard right now, with the XAU at 81.85. International ETFs, the Japan ETF having a great day, up over 1.5%. And as far as laggards go, Brazil and Australia are the laggards, with Brazil down over 1% right now for EWZ. And with that, I'm going to conclude our market update. Was there anything you wanted to add to that, or do you want to get right into what would you do?
I got just one thing real quick. This something that's developed here recently. You can see this is a Russell 2000 relative to the S&P 500, and we were seeing strength on a relative basis throughout March. And some of it seemed to be tied to maybe the trade, at least part of it may be tied to the trade war, and part of it tied to the dollar, which had strengthened. And then, of course, over the weekend, China came back and said, hey, we're willing to maybe sit down at the negotiating table. And so, there hasn't been as much fear with the trade and with the trade war. And as a result, I think that's part of why the Russell 2000 has been dropping. Also, the fact that the dollar has been pulling back. So here is that relative weakness that all of a sudden we've seen develop. And if we pull up the UUP, which is the kind of the proxy for the dollar, you can see that the dollar has fallen to about a 1 month low in recent, between yesterday and the weakness that we saw earlier this week. So that UUP moving down, I think, also is putting some pressure on the Russell 2000 relative to the S&P. I just wanted to point that out because I have been talking a lot about the relative strength in the Russell 2000, but with what you were just showing with Russell 2000 down while the Dow and the S&P are rising, it does seem to be perhaps taking a little bit of a short-term toll on the Russell on a relative basis.
All righty. What would you do? What would you do?
What would I do? Do you want me to go first?
Yes, I think you should go first, and then I'll have the last word today.
All right. Well, let me think about how I wanted to talk about this. So of course, the question is, what would you do with the XLF right now? Would you be a buyer? Would you be a seller? Would you just avoid it? And so let me pull up the XLF first. And let's take a look at it. So the XLF, it looks like, we saw the huge down day the last couple of days, and banks have really struggled. And part of that is because we've seen Treasury yields consolidating and moving toward the low end of the range. And that tends to have a negative impact on financials. So, we topped back in January, early February on the 10-year Treasury yield. And we did the same thing with the XLF. It is very dependent. Parts of the financials are very dependent on the direction of the 10-year Treasury yield. I'm still bullish on the Treasury yield. I think the Fed's going to continue to raise. I think eventually we're going to see a breakout above that 3% area that I talked about earlier when I was highlighting Arthur's Don't Ignore This Chart blog article from back in January. So when I look at the financials at this point, we did just kind of put in a double bottom, which I think is encouraging. I also think that we held on to a key support area right here at about the 2670 level. We tested it in February, went almost right back down, put in this double bottom, and we're starting to move back to the upside. So now a break back up above that double top would be very bullish. In the meantime, we're likely to see more consolidation. And I won't save this annotation, but what I wanted to show was the XLF, and I'm going to go back. Let's go back. I'll tell you what, let's do a weekly, and let's go back a few years. I might want to stretch this out even further. So this is going to be a chart of the XLF, but instead of the RSI, I don't really want to. I want to show this relative to what's been going on with the 10-year Treasury yield. So I can pull up price, show the 10-year Treasury yield, and instead of showing it below the chart, I'm going to put it behind the price so that we see the movement of the TNX with the XLF. And then I'm going to color it pink just so it stands out really nice. And I don't really need candlesticks. Let's just go with a solid line. Same thing here, solid line. And let's take a look at this chart. So this is the XLF, the black line, and then the pink line is the TNX. I think you can probably look at this and see there's a pretty strong correlation between the direction of Treasury yields and what's going on with the XLF. Now, we had a huge move up here in Treasury yields, and you can see the XLF also moving up very strongly. But as the 10-year Treasury yield consolidated and drifted lower, you can see that really had an impact on the XLF as it really struggled to go any higher. But once the big move in the Treasury yields started again, you can see the XLF going right with it. And now we're consolidating. And we've talked about this for the last several weeks, that we expected to see consolidation on the 10-year Treasury yield because of a negative divergence on that on the PPO. So we've been sideways consolidating, and I think that's having a negative impact here on the financials in the near term. But I believe that the 10-year Treasury yield is going to go higher after this consolidation. We may go a little bit lower, and we may really spook. The market could get spooked if we drop much below 280 on the 10-year Treasury yield, but I think it would set up opportunities on the XLF. The other way to look at this is let's get rid of the XLF and let's take a look at the banks, the DJUSBK with the 10-year Treasury yield behind it, and you're going to see very similar chart where when the 10-year Treasury yield goes into a period of consolidation, banks tend to struggle. But I do think that this is setting up an opportunity. So my answer would be, I would be a buyer of the XLF, knowing that there could be a little bit more consolidation ahead. If I had to say, you know, do I want to own this for the next year? My answer is yes, I would be a buyer.
All right. Let me give you my opinion.
All right.
Okay. First of all, I want to show you really quickly, if I can get there, the decision point sector scoreboard, because I think this is what really triggered me to ask the question of Tom earlier this morning about XLF. I just got this neutral signal on my intermediate term trend model, and I'll show you that on the chart. But this, I think, is very concerning. You know, we are on all these neutrals. We still have aggressive sectors, though, on the buy side, but we're starting to see so many of these pull back and move into that neutral category. When I start seeing a long-term trend model buy signal come in on consumer staples, on real estate, on utilities, I think that's when I would get especially concerned about a bear market. I think this really does speak to a corrective move that we're going through right now. So let me go ahead. I'm going to show you my charts for XLF. And here's my first one. So I was looking at it, and I'll just tell you my camp. I'm going to actually be in the leave it alone camp. And that's why, because I think things are still rather shaky. I still am not sold on the fact that the correction is over. You know, I think that this looks really promising, as I think you used the word encouraging. You know, we hit this area of very strong support, and we did bounce off of it, the 200-day EMA included. But this double top, you know, we never quite came down to the target, the minimum expectation target from the double top. And that concerns me. Like I said, I like the bounce, but we haven't gotten over the confirmation line at this point. So the double top, in my opinion, is still in play until you get and I won't go decisive 3% move above that confirmation line. I would just say if we got a sizable move and close above that confirmation line, then I would be willing to give that double top up and turn into a more bullish position. You know, I thought it would be interesting to also look at the equal weight version of the financial sector. And you can see it actually hasn't had that intermediate term trend model neutral signal yet. The 20-day EMA is still sitting above the 50 when you're looking at the equal weight. We do see, though, that if you're going for that double top setup here, we definitely didn't go down and test the area, which would have been around here for the expected minimum downside target on a double top, would have been pretty much right here at that 40-50 level. So I think it's encouraging, as we were saying, we're getting that bounce where we need it to be on that very important support line here at these tops back in October, November, and that 200-day EMA. But my PMO is still on a sell signal. It has now gone below the zero line, and RYF has actually been a bit stronger. I don't actually have the relative ratio set up here. Let me see if I can see it. But typically you'll see on the upside we do better on that. But, you know, let's see. I am going to go with it this way. Now everybody can see how to set up a relative price relative here. And so I'm going to do RYF, no F, to XLF. Let's just see what's going on as far as your equal weight versus your cap weighted. And you can see that typically we're going to see a bit better performance there by the equal weight on the way up. What I've found is that on the way down, that's when you usually see, I would say, better performance out of the cap weighted, only in that it doesn't generally pull back as quickly and as fast as the on the way up. So what I'm saying here is when I look at these, I think we've got some very important overhead resistance still. We never really met the expected downside targets. I still think we're sitting in a corrective mode. And honestly, when I just did that market update and I see, money The market is up today, but where is it up? It's up in those defensive sectors, and that's what concerns me. And we're not getting these breakouts on XLF today, even though we're seeing a pretty nice upside move on the market in general. So I would leave it alone. That's pretty much where I would be. And let's see, what does the poll say after? I don't know if we can pull up that poll currently. Yes, so I said avoid, and it looks like the majority of people, well, I'm looking at the poll right now, it's 56%. There we go, buy, hold. So at this point, you are winning. Your camp is winning. I think I might have hopefully convinced a few people about that avoid, and we'll see what happens.
Well, I'm gonna take the screen, use your charts, and I'm gonna show you one thing. Can I do that?
Yes, you may.
I'm gonna play devil's advocate here.
Oh boy. Okay.
Okay, so now here's the chart. Now, of course, you're arguing, you're getting that intermediate term sell signal where your 20 drops below your 50.
Yep.
You can see down here the PMO's crossed below the
line.
That center line, PMO center line. But I want you to look back to April of 2017. We got the exact same setup. While we were consolidating, we got that negative crossover there, which is that intermediate term neutral, I guess, signal. But notice we went down and we tested price support. We never lost the price support before we went higher. And I see the same type of pattern setting up here where we broke out above 2670, went down, tested it, came back up, struggled, came back down for a second time, double bottom. In this case, we actually had a triple bottom. But both times we had crossovers below the center line. So, and the reason I bring this up is not to say really anything bad about the PMO, because to me, it's very similar to the MACD and the PPO in that sometimes when you're consolidating, these signals can turn negative for a period of time, just like we saw back here in April and May where we went below the zero line before we rallied. So anyway, I'm not trying to convince anybody. I'm just putting my additional 2 cents in.
Yeah, I feel like, that the deep correction we got, we're so far below that 50-day EMA. I'm not certain we're going to see much whipsaw on that intermediate term trend model neutral, but I think we're at the whole point of avoiding it. I'm not like negative. I'm not saying sell it. It's just we have some really important resistance to get over to convince me that it's a good time to actually get into XLF.
Yeah, and the big reason I like it, number one, I think we're still in a bull market, and number two, I think interest rates are going to go higher, and as a result, XLF historically you want to be in financials if rates are going up. Now, if you believe rates have topped and we're going back down, then I would completely agree with the avoid. No doubt.
Yes. All right. Well, it's always interesting.
Yeah, we just got about a minute or so left, so I wanted to maybe quickly go over some of the things that we have coming up.
Absolutely. Yes, we have quite a bit coming up this week. We still have Mark Young. He is going to join us tomorrow. He is from wallstreetsentiment.com, Wall Street Sentiment Survey, and he will talk with us about sentiment. Arthur Hill, we're very excited to have him on Thursday. And then, of course, Friday, the market is closed. So sadly, or I don't know, not sadly, we won't be here on Friday morning. Not much to talk about if the market's closed.
No, not a whole lot to talk about. But I do want to thank everybody for stopping by, being with us today. Remember to complete that survey as you exit. It's underneath the chat. It says, how did we do? Just click on that link and you can give us some feedback. We'd love to get your feedback, hear what you think of Market Watchers Live. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. We'll see you back here on Wednesday. Happy trading.